In March, the Federal Reserve promised one rate cut before the end of this year. By June, that promise was gone, completely erased, and quietly replaced with talk of a hike instead. This is the fastest reversal in Fed guidance in recent memory, and it happened during a brand new chairman's very first meeting. Hit subscribe right now because this channel breaks down what's really happening with your money before mainstream coverage catches up. Drop a comment below telling me if you're worried about your portfolio right now, because this story changes things fast. And stay until the very end, because something most analysts are completely missing gets revealed later on. Let's get into it, because this story moves fast, and you need every single piece of it. On June 17th, the Federal Reserve held its benchmark interest rate steady at 3.50 to 3.75%. That sounds boring on the surface. Rates didn't move, nothing changed, right? Wrong, because what changed wasn't the rate itself, it was the entire roadmap for the rest of the year. 3 months earlier, in March, the Fed's own projections showed one rate cut coming before year end. That projection is officially gone now, deleted, replaced with something nobody on Wall Street was fully prepared for. The median projection from Fed officials now sits at 3.8% by year end. Read that number again, 3.8%, higher than where rates sit today. That means the median official on the committee is no longer thinking about cutting, they're thinking about hiking. 9 officials out of 18 who submitted projections see at least one hike coming this year. Only 9 see no change or a cut, meaning the committee flipped from leaning toward easing to leaning toward tightening. This is the first meeting under brand new Fed Chairman Kevin Warsh, and it could not have gone the way anyone expected. Warsh was selected specifically because he was viewed as someone who would push for lower rates faster. President Trump publicly pushed for this appointment, hoping for exactly that outcome, aggressive rate cuts. Instead, in his very first meeting running the show, Warsh oversaw a Fed that moved the opposite direction. The Fed statement itself was rewritten, dramatically shorter, and stripped of language suggesting any bias toward future cuts. That single change in wording sent a signal louder than any single rate decision could have sent. And here's something fascinating. Warsh refused to even submit his own personal rate projection for the year. He told reporters directly, quote, "I did not submit a dot for me. It's not helpful in the conduct of policy." Think about that for a second. The man running the Federal Reserve declined to show his own hand. That kind of uncertainty from the very top is exactly what spooked markets within minutes of the announcement. Now let's talk about what actually happened to your money, because this is where it gets real. The Dow Jones Industrial Average had closed at a fresh record high just one day earlier. Within hours of this Fed decision, the Dow dropped over 500 points, roughly 1%, erasing that record high momentum instantly. The S&P 500 fell 1.21%, landing around 7,420. The NASDAQ, loaded with tech and AI stocks, dropped 1.34% in a single session. Major tech names led the slide. Microsoft, Meta, Alphabet, and Amazon all closed deep in the red. The VIX, Wall Street's so-called fear index, spiked 12% in a matter of hours. That spike in the VIX tells you institutional money got nervous fast, not retail traders, real institutional positioning. Treasury yields jumped too. The 2-year yield gained more than 16 basis points almost immediately. The 10-year Treasury yield climbed to roughly 4.497% by the close. Now, why does any of this matter to a regular American sitting at home watching this video? Because higher Treasury yields ripple directly into mortgage rates, auto loan rates, and credit card interest. If the Fed pivots toward hikes instead of cuts, borrowing money gets more expensive, not cheaper, going forward. That mortgage you were hoping would drop this year, this pivot makes that far less likely now. Redfin's head of economics research said it clearly: we're in a new era, and markets need time to adjust. She added that the committee is taking inflation very seriously, meaning mortgage rates are unlikely to drop soon. Let's talk about why inflation suddenly became the dominant story again, because this is the real engine here. May's Consumer Price Index came in at 4.2% year over year, the highest reading since 2023. That's not a small miss. That's nearly double the Fed's long-standing 2% target for inflation. The primary driver behind this inflation spike traces back to the conflict between the United States and Iran. That conflict, which began earlier this year, sent oil prices from around $67 a barrel skyrocketing. At its peak, oil hit an intraday price of $119.48 a barrel. Energy costs feed into nearly everything: transportation, manufacturing, food production, heating, and electricity generation across the entire economy. When oil spikes that violently, inflation doesn't stay contained, it spreads through the entire supply chain fast. This is exactly why the Fed's tone shifted so dramatically between March and June this year. 3 months ago, policymakers believed disinflation was firmly on track, justifying a cut later in the year. That belief has now completely reversed, replaced by genuine concern that inflation could re-accelerate from here. On top of inflation, the labor market has stayed surprisingly resilient, which removes urgency for the Fed to cut. A strong jobs market combined with sticky inflation gives the Fed zero reason to rush toward easing policy. In fact, several Fed officials at recent meetings pushed to remove language suggesting any bias toward future cuts. Minutes from earlier meetings showed officials discussing the idea that policy firming, meaning hikes, might become necessary. That's a massive shift in tone from a Fed that spent most of last year signaling the opposite direction. Now here's something most people watching financial news completely missed in the noise of this announcement. Before this meeting, market pricing tools showed traders expecting essentially zero chance of any cut in 2026. Instead, traders were pricing in roughly a 60% probability of at least one hike before year-end. After Warsh's press conference, that probability of a hike climbed even further in some trading models. That is a complete 180-degree reversal from where market expectations stood at the start of this year. Think back to January. Most investors assumed 2026 would be the year of aggressive Fed easing. Instead, we're sitting here in June with hike odds rising and rate cut odds essentially at zero. This is precisely why the headline you clicked on isn't clickbait. The Fed effectively canceled the cuts. Not through a single dramatic announcement, but through a slow, steady erosion of expectations over just a few months. And the market sell-off you're seeing isn't some random one-day blip. It's a repricing of reality. Wall Street spent months pricing in cheaper money, lower borrowing costs, and easier financial conditions for businesses everywhere. That entire narrative just got rewritten in real time, and stocks are adjusting to the new story. Here's a fact that puts this into perspective for anyone who thinks the Fed moves slowly and predictably. Jerome Powell, the previous Fed chair, had a final policy statement that ran roughly 341 words long. Warsh's first statement was dramatically shorter, intentionally stripped down, removing the very language that signaled future direction. When a central bank stops giving forward guidance, markets lose their map, and that creates volatility immediately. Without clear guidance, every single economic report between now and the next major meeting carries enormous extra weight. That means June and July inflation data will move markets more violently than they normally would. It means the next jobs report could swing rate expectations dramatically in either direction within hours. This is the new environment investors are operating in. Higher uncertainty, less Fed handholding, sharper market reactions. Now let's connect this back to history for a second, because context matters here enormously. The Federal Reserve's very first rate cut in history came as a response to the 1929 crash. Since then, the Fed has used rate policy as its primary tool to either cool or stimulate the economy. Cutting rates stimulates growth by making borrowing cheaper, encouraging spending, investment, and economic expansion across every sector. Hiking rates does the opposite. It cools inflation by making borrowing more expensive and slowing economic activity down. Right now, the Fed is signaling it may need to lean toward cooling rather than stimulating the economy. That's a meaningful shift because most Americans built their 2026 financial plans assuming the opposite scenario. If you were waiting for mortgage rates to drop before buying a home, this changes your timeline significantly. If you're carrying credit card debt expecting relief from lower rates, that relief just got pushed further away. If you're running a small business expecting cheaper loans this year, you need to rethink that plan immediately. This isn't fear-mongering, this is simply what the data and the Fed's own words are telling us. There's a specific date coming up that could either confirm this hawkish pivot or completely reverse it again. There's a specific inflation number the Fed is watching closer than any other data point right now. And there's a reason why bond market veterans are calling this one of the most consequential meetings in years. Stick with this breakdown, because the data points that move your money in the coming weeks matter enormously. Make sure you've subscribed, because what's coming next builds directly on everything you just heard. There are specific dates circled on every trader's calendar right now, and you need to know them too. The next FOMC meeting is scheduled for July 29th, but don't expect a new dot plot there. That means July's meeting will be a pure vibes check. No fresh quarterly projections, just a policy statement. The real fireworks come on September 16th, when the next full summary of economic projections gets released. That's the date when we find out if this hawkish pivot is real or just a temporary scare. Between now and then, every single economic report is going to carry significantly more weight than usual. Here's why. Without forward guidance from the Fed, the market has no map, so data becomes the map. Watch June and July CPI releases closely, because they'll show whether this inflation spike is actually cooling down. If oil prices keep unwinding from their war-driven highs, inflation could ease faster than people currently expect. But if oil stays elevated or climbs again, the 4.2% CPI print could go higher. PCE inflation is even more important because it's the Fed's own personally preferred inflation gauge, not CPI. June's PCE data, which gets released in July, could be the single most important number of the summer. If PCE starts falling meaningfully, the probability of a hike drops fast, and markets could calm down quickly. If PCE stays sticky or rises, expect the hike probability to climb even higher than it already has. Then there's the jobs market, specifically non-farm payrolls data coming out in July and August this year. A softening labor market would actually give the Fed a reason to pause any hawkish lean and stay patient. But if jobs numbers stay hot, like they have recently, that removes any incentive for the Fed to ease. This creates a strange situation where good economic news for workers can be bad news for stock prices. That sounds backwards, but it's exactly how markets have been behaving for the past several months now. Remember, strong labor data plus sticky inflation equals zero urgency for the Fed to cut rates anytime soon. That combination is precisely what flipped market expectations from rate cuts to potential hikes in such a short window. Now here's something that should genuinely concern anyone holding growth stocks or AI-related companies right now. Tech and AI companies are what professional analysts call long-duration assets, and that term matters here. Their valuations depend heavily on profits expected years into the future, not just current quarter earnings. Those future profits get discounted back to today's dollars using an interest rate. That's the key mechanic. When the discount rate goes up, the present value of those future profits mathematically goes down immediately. This is exactly why tech stocks got hit harder than other sectors during this entire repricing episode. Microsoft, Meta, Alphabet, and Amazon weren't randomly chosen as the biggest losers. They're business models. Explain why. These are exactly the companies most exposed to long-term growth assumptions that depend on cheap money. If rates stay higher for longer or actually rise, these valuations face continued pressure going forward. Meanwhile, sectors with more predictable near-term cash flows tend to hold up better in this environment. This is part of why we've seen a rotation story playing out underneath the surface of these indexes. Small caps and value-oriented stocks have actually performed better than people realize amid all this chaos. The Russell 2000 has shown resilience at times when the Nasdaq was getting crushed during the same session. Some analysts are calling this rotation the, quote, great rotation, money moving from speculative tech into steadier names. A resilient domestic economy, even with higher yields, can actually benefit cyclical, value-tilted, regionally exposed companies. This is a nuance most headlines completely miss when they just scream about a market crash happening. It's not necessarily a crash, it might be a rotation, and that distinction matters enormously for your portfolio. But don't get too comfortable, because there's still real risk sitting underneath all of this rotation talk. If inflation truly does reaccelerate and the Fed is forced into an actual hike later this year, everything changes. A confirmed hike would be the first rate increase in years, marking a genuine regime change in policy. That would mean borrowing costs across the entire economy rise, not just market expectations shifting around. Mortgage rates, auto loans, business loans, credit cards, all of it gets more expensive in a real hike scenario. This is why bond market veterans are calling this one of the most consequential Fed meetings in years. Because it's not just about one meeting, it's about whether the entire multi-year easing cycle is over. For most of the past few years, the dominant assumption was that rates would gradually trend lower over time. That assumption just took its biggest hit yet, and markets are still figuring out how to price it. Here's another angle that deserves attention: the unusual decision by Chairman Warsh to skip his own rate projection. By declining to submit a personal dot, Warsh effectively added another layer of uncertainty onto an already uncertain situation. Markets hate uncertainty more than they hate bad news, because at least bad news can be priced in. Uncertainty means investors don't know what to price, so volatility tends to stick around longer than expected. Warsh did reveal something else important, though. He's forming task forces to review the Fed's entire communication framework. That includes the dot plot itself, press conference scheduling, meeting frequency, transcripts, and minutes, basically everything. This signals a genuinely new era at the Federal Reserve, different from how Jerome Powell ran things for years. Whether that turns out to be cosmetic or substantive will become clear over the next several months. If Warsh holds rates steady all year and inflation actually falls, this entire episode might look minor in hindsight. But if inflation stays elevated and a hike actually happens, June 17th will be remembered as the turning point. Either way, what's clear right now is that the easy money assumption millions of Americans built plans around is gone. Let's bring this back to something extremely practical, because numbers on a screen mean nothing without context. If you assumed mortgage rates were going to drop significantly this year, you need to revisit that assumption now. If your business plan depended on cheaper financing becoming available later this year, build a backup plan immediately. If your investment strategy assumed continued multiple expansion in tech stocks fueled by falling rates, that thesis is challenged. This doesn't mean panic. Panic is rarely a good investment strategy, but awareness absolutely matters here. Smart investors aren't reacting emotionally to one volatile trading session. They're watching the data points we just covered. CPI in June and July, PCE in July, jobs reports in July and August. Then September's full projection update. Those are the checkpoints that will tell you whether this is a temporary scare or a lasting shift. There's one more piece of this story that almost nobody is connecting properly, and it involves market structure itself. Remember, the day before this Fed decision, the Dow had just closed at an all-time record high. That means this entire sell-off happened from a position of strength, not from a market already in trouble. Markets that fall from record highs on policy uncertainty often behave very differently than markets falling from weakness. This could be healthy repricing after a strong run, or it could be the first crack in something bigger. The truth is, nobody knows for certain yet. Not the Fed, not Wall Street, not financial media. What we do know is the data, the actual numbers, and those numbers tell a very clear story. Inflation is hotter than expected, the labor market is stronger than expected, and rate cut hopes have evaporated. That combination, by definition, removes the easy bullish narrative that drove markets higher earlier this year. There's a deeper layer most coverage completely ignored, involving what's happening behind the scenes with bond market positioning. There's also a critical detail about how this Fed chair's appointment came about that explains his cautious approach. And there's a specific historical parallel from a previous Fed transition that almost perfectly mirrors what's happening now. If you've made it this far, you already know more about this Fed decision than most financial news viewers. Drop a comment, letting me know which fact shocked you the most so far. Every comment gets read. And if this breakdown has been valuable to you, hit that subscribe button before the next layer unfolds, because what comes next ties everything together, and it changes how you think about the rest of 2026. Behind the scenes, bond market positioning tells you something the headlines completely glossed over this week. Before this Fed meeting, institutional bond traders had already started reducing their exposure to long-duration treasuries. That's a quiet signal. Professionals moving money before the public headlines catch up to what's coming. When the 2-year yield jumped 16 basis points in hours, that wasn't retail panic, that was repositioning. Big institutional desks read the dot plot in real time and adjusted portfolios within minutes of release. This is why you'll often see Treasury yields move before stock indexes fully react to the same news. The bond market is widely considered the smarter, faster-moving cousin of the stock market in moments like this. When bond yields spike sharply on a no-change rate decision, it's the market repricing future expectations instantly. Higher yields mean investors are demanding more compensation to hold government debt over a longer time horizon. That happens when investors believe inflation will stay elevated longer or that rates will stay higher for longer. Both of those beliefs just got reinforced by this Fed meeting, which explains the speed of the yield move. Now let's talk about how Kevin Warsh actually got this job, because it explains his cautious public posture. President Trump pushed hard for a Fed chair who would cut rates aggressively to support growth and lower borrowing costs. Trump had previously clashed publicly with Jerome Powell, criticizing him repeatedly for not cutting rates fast enough. Warsh's appointment was initially read by markets as a clear signal that aggressive easing was coming soon. But here's the twist. Almost nobody saw coming. The rest of the committee doesn't answer directly to the president. The Federal Open Market Committee operates with regional bank presidents and governors who vote independently on policy. Many of those officials have spent the past year worried about losing credibility on inflation if they cut too soon. That's why JP Morgan's chief economist made an important point. Other committee members may act as a brake on Warsh. Even if Warsh personally wanted lower rates immediately, he doesn't get to single-handedly override the entire committee. This explains why his very first meeting produced a more hawkish outcome than the market originally expected. It also explains why he chose not to submit his own personal dot for this projection round. Submitting a dot that diverged sharply from the committee could have signaled internal division at the worst possible time. By staying silent on his own projection, Warsh avoided publicly contradicting his own colleagues during his debut meeting. That's a politically careful move, but it also added to the uncertainty that rattled markets that same day. Now here's a historical parallel that almost perfectly mirrors what's happening with this leadership transition right now. When Paul Volcker took over as Fed chair decades ago, he was brought in to fight runaway inflation aggressively. Volcker's tenure became defined by a willingness to raise rates dramatically, even when it caused real economic pain. Markets initially underestimated how serious Volcker would be about prioritizing inflation control over short-term growth concerns. The parallel here isn't perfect. Warsh wasn't brought in explicitly to fight inflation. He was brought in to ease policy. But the lesson is the same. New Fed chairs often behave differently in office than markets initially expect. Expectations built around a single nomination can shift dramatically once that person actually sits in the chair. This is exactly what's happening with Warsh right now, and markets are still adjusting to that reality in real time. Every new Fed chair inherits a committee, a set of data, and constraints that shape decisions beyond personal preference. Warsh inherited a committee facing 4.2% inflation and a labor market that refuses to weaken. Given that backdrop, a hawkish first meeting actually makes more sense than markets initially priced in beforehand. Let's zoom out now and talk about what this means for the broader 2026 economic picture. GDP growth in the first quarter came in at just 1.6% annualized, below the long-run trend. That's a slower growth number than many expected, yet it hasn't been enough to push the Fed toward cutting. Why? Because inflation has taken clear priority over growth concerns in the Fed's current decision-making framework. This is the classic dual mandate tension, balancing maximum employment against stable prices, playing out in real time. Right now, the Fed is leaning hard toward the price stability side of that mandate, not the employment side. That's a meaningful philosophical shift from periods when the Fed prioritized supporting growth even with inflation slightly elevated. For everyday Americans, this means borrowing costs are likely to stay elevated for longer than previously assumed. It means saving accounts and certificates of deposit may continue offering relatively attractive yields for now. It means companies relying on cheap debt to fund expansion will face a tougher financing environment ahead. It means the housing market, already strained by affordability issues, gets very little relief from falling mortgage rates. Rocket Mortgage's chief business officer made an important point worth remembering. Home sales respond to job security too. Even with rates staying elevated, a healthy labor market still brings buyers into the housing market regardless of Fed moves. That's a slightly more optimistic angle buried inside an otherwise hawkish, uncertain story about borrowing costs. Now let's talk about what smart money is actually doing right now, based on the data we've covered. Institutional investors aren't abandoning the stock market entirely. They're rotating exposure toward more rate-resilient sectors and companies. Financials, certain industrials, and value-oriented stocks tend to hold up better when rates stay elevated longer. Long-duration growth stocks, especially unprofitable or speculative tech names, remain the most vulnerable in this exact environment. This doesn't mean avoid the stock market. It means understand which parts of the market carry the most risk right now. Diversification matters more in an environment like this than it did during the easy money years before this. Cash and short-term instruments have become more attractive again now that yields have stayed elevated for this long. That's a meaningful shift from years when near zero rates made cash a poor place to park money. Let's also address something important. One volatile trading session doesn't define the entire rest of 2026. Markets move in both directions constantly, and a single Fed meeting, however significant, is one data point among many. The real story unfolds over the coming months as CPI, PCE, and jobs data roll in one by one. If inflation cools as oil prices continue normalizing after the Iran conflict, this entire hawkish narrative could soften quickly. If inflation stays sticky or accelerates again, expect continued volatility and a real possibility of an actual rate hike. Either path leads to a different 2026 than the one most investors were originally planning for in January. That's the core takeaway here. The plan everyone built around guaranteed rate cuts needs a serious second look right now. The Fed didn't just pause, it fundamentally rewrote the expected path for monetary policy in a matter of months. Kevin Warsh's first meeting will likely be remembered as a turning point, regardless of which direction this ultimately goes. Whether history judges it as the moment inflation got contained, or the moment a hike became inevitable, remains unwritten. What's certain is this: the easy assumption of falling rates throughout 2026 is no longer a safe bet. For your mortgage, your savings, your investments, and your business plans, that single shift in assumption matters enormously. Pay close attention to June and July CPI, the upcoming PCE release, and the jobs reports landing this summer. Watch September 16th closely, because that's when the next full picture of the Fed's true direction gets revealed. Until then, expect continued volatility, sharper market reactions to data, and a Fed that's deliberately keeping its options open. That's the complete picture of what just happened, why it happened, and what to watch for next. If this breakdown helped you understand the Fed decision better than anything else you've seen, that means everything to this channel. Hit subscribe right now if you haven't already, because every one of these developments gets tracked here. Drop a comment below sharing your biggest takeaway from this entire breakdown. Your input genuinely shapes future videos here. Share this video with anyone you know who has money in the market and needs to understand this shift. Thank you for staying until the very end. That tells me you actually care about understanding your money deeply. Stay sharp, stay informed, and keep watching closely because this story is far from over.